Now, I think that pretty much everybody, almost everybody in this room, was happy to see the back of the markets in 2022. It was a brutal year, and we started 2023 on a little bit more of an optimistic note. The lifting of pandemic restrictions, the excitement that was being generated around generative AI made us think, 2023, maybe there's something to this. But, however, in the second half of the year, the markets have cooled, and now it looks like interest rates are going to be stuck with us for some time. So there may be some dark clouds on the horizon, but the good news is that our panel that we have coming up the stage are undaunted. They are looking at the markets, they are looking at the trends, and they are looking for the opportunities. They are going to be led in discussion today by Jin Su, the Asia Pacific President for the Bank of America. Jin Su is going to come on up and be joined momentarily by Peter Harrison, who's the Group Chief Executive at Schroders. We're also fortunate to have Marc Rowan, who is the CEO at Apollo Global Management. We have David Solomon, the Chairman and CEO of Goldman Sachs, and we also have CS Venkat, who is the Group Chief Executive at Barclays. And with that, Jin Su, I think you're ready for action.
We're ready.
Take it away.
Good morning, and welcome to Hong Kong. And thank you guys for being here. So as the title of the summit this year rightly pointed out, 2023 has been a complex year for investors. While the rate hike cycle may be nearing its end, the prospects for higher for longer has been an overhang for the market. Capital markets activity has been relatively muted. Global equities, which rebounded significantly earlier this year, had significant corrections last year. But we had the momentum of the rally fizzle out, during the year, and for bonds, expectations of higher for long has led to a pretty decent sell-off recently. So perhaps maybe let me start with our banking colleagues. So this one's for David. In the summit last year, you were asked on the dramatic slowdown in the global IPO activity and the prospect of higher for longer taking its toll on corporate debt issuance. And this year, things don't seem to have gotten a lot better. Global IPOs are still pretty weak in terms of overall volume and capital raised, while higher for longer means that it's affecting corporate lending rates. So what is your outlook in terms of capital markets activity, and what do you plan to do about it?
Well, thank you for having me. I don't know that I can do much about that, but we can talk a little bit about the environment, just from a big picture. I would say that 22 was a more complicated year than 23 has been, just because we went through such a dramatic change coming out of 2021 and the beginning of a very, very significant tightening process. So as you highlighted, equity markets and debt markets both were negative in 2022, which is something we had not seen in over 50 years in the same year. And that obviously took a lot of confidence out of markets. As we look at 2023, there's no question that capital markets activities have been low, but capital markets activities, particularly in the second half of the year, have started to pick up a little bit. Capital markets activities really start with confidence, and we still are at a very, very uncertain time. But at the same point, as people reset their expectations, both for the cost of financing, for valuations in markets, ultimately businesses need to finance, they need to fund, they need to bring themselves to the public markets. And so generally when you see a significant correction or a significant change in the macro environment, as we've seen over the course of the last 18 months, it takes a period of time for that reset to occur. History would tell you, 6 or so quarters, we've kind of gotten past that. We saw in September a little bit of a pickup in IPO activity in the United States, but it's still a pretty uncertain time. We obviously have the conflict in the Middle East, which brings more geopolitical uncertainty. And we also have had, big moves in rates in both directions, here over the course of the last couple of months, which slows down confidence. I'm not really equipped to predict the short-term direction of travel, but I bet a lot of money that in 2024, we'll see a pickup in capital markets activity just because they've been closed for a period of time. Companies need to finance. As the duration goes out, there's more financing work that needs to be done. And so we can operate with very, very healthy capital markets in a 5% interest rate environment. but the period of reset and acceptance takes some time. We're on that journey, and I think you'll see, a more constructive market environment for capital markets as we move into 24 and 25.
Thank you. Venkat, pretty astonishing bond sell-off recently. I read with interest that there was a piece of news that said Barclays had a report that said, equity crash is what is required, to rescue the bond market. So why is Barclays taking such a pessimistic view? And separately, building on the question from David, how do you cope with the what can lead to a decrease in investment banking revenues? And we do note that Barclays is heading into the U.S. credit card market, partnering with Xbox. So I'd like you to also maybe expand a little bit on that.
Well, thank you again. Like David, I'm very happy to be here, so thank you for inviting me. So the analyst who wrote that piece in 2007-8 said that Fannie Mae and Freddie Mac were undercapitalized. I didn't listen to him then. I'm not saying I've listened to him every time, but what he was saying was, there was a point I think Bob Prince was making in the previous panel, that there is no natural level of US yields right now, long-term yields, which is finding a buyer. And part of that is because, well, rates have backed up, but the deficit has ballooned in the US. And then natural buyers of US treasuries were central banks, and the developed market central banks have obviously been selling. And those asset gatherers and asset owners, especially in this region, many of you are represented here, you know far better than I do what you're going to do with your investments in US treasuries. So what he was saying was it's putting an upward pressure on interest rates. And so he surmised that equities having a sell-off might bring buying into treasuries. But the basic point, I think, is right, which is the upward pressure on US treasuries because of basic structural reasons is great. And it is one of the factors that I think will contribute, as David just said, to the return of investment banking activity, seeking some more clarity, right? So people have to have business logic for what they do. They've got to bring companies to market or look for mergers, but they've also got to be secure about their financing and be able to operate at that higher level of financing. As far as credit cards and Xbox in the US, well, I'll tell you, we've got a consumer business, obviously, in the UK, and we've got a credit card business in the US, which is a business-to-business thing. So the Xbox demographic of gamers who apparently like to spend with their credit card and use the points to buy things on Xbox. Apparently, it's a sizable demographic. It may not be well represented in this room. But we are banking on its persistence and strength.
Thank you. Peter, I'd be very interested in your views as a multi-asset manager. What is your view on bond yields? And, given that equities also rose significantly in the first half of the year, but kind of petered out in the second half, how do you see global equity market for the rest of the year?
Thank you, and again, thank you for being here. Look, we've finished the era of bonds being return-free risk, and we're now into the next era where they do at least offer something. But I've got a lot of sympathy with what Venkat said, that we're in an environment where the data is about as dirty as it's ever been, and we've got the post-COVID savings. We don't quite know how they're washing through. We don't know what the inflationary impact of commodities washing through is. We've got all sorts of deglobalization trends. We've got decarbonization trends. I think that the understanding corporate profitability and understanding defaults is particularly difficult right now. And as Bob was saying in the last session, the issuance cycle is against us all. So I think we're in a really difficult period where the data is really noisy. And frankly, there is a very significant outflow across pretty well all equity market platforms around the world of people saying, I prefer cash. It's worth understanding that the average retail investor lost, the more low risk they were last year, they lost 10, 15, 20% of their money. So when you offer them the opportunity to put some money in cash with a guaranteed return, they're grabbing it with both hands. I personally feel there's quite a long way to go before we feed to some sort of normalization. We're 1 year into a new normal. That takes us another 12, 13 years of party time to wash through. And that isn't going to happen in a hurry, right? We haven't yet found out where all that debt went. I mean, if you take a step back, between equity markets used to grow pretty much in line with GDP. Since 2000, they've outperformed GDP by about 130%. Real estate's outperformed by 33%. There's a very, very significant growth in wealth, about 160 trillion of excess return that's been created in the world, largely through debt. That reset is going to take a long time to wash through.
In your view, how long will this reset take?
Measure it in years, not months.
Thank you. Marc, credit.
I hate to be the optimist in this crowd.
Okay. Let's hear the opposite side of the story. Credit has been a big part of Apollo's business. So alongside the bond market, private credit has been gaining a lot of significance in the economy as a lender in the recent years. So with private credit expanding into the broader credit markets, what is your perspective on the competition and collaboration with traditional credit providers such as banks and also the corporate bond market?
Look, I think we're in the first inning of private credit. I think we've done a poor job defining it, but I start in a more macro place. Credit demand in any country is a function of GDP, and regulators and governments have a choice. That credit can be provided by the banking system, or that credit can be provided by the investment marketplace. There's no third choice. Each country is making its own choice as to what the right mix is. But if I look around the world, debanking is taking place. That doesn't mean quickly. That doesn't mean banks are going out of business. That just means on the margin, regulatory pressure is pushing banks to increase their capital, which is pushing banks out of certain businesses. I don't know that that's necessarily a bad thing, because I look at our business, and most of what's been focused on thus far in the press as private credit is actually levered lending, which is a very, very small piece of the banking system. The trend I'm talking about is what a bank does every day. Where does the $50 million or $100 million borrower go for credit? Well, they used to go to the bank. Now they're coming to the private credit market, and that is being turned into investment-grade credit through securitization. In general, asset managers such as us, we only want the asset. Banks offer a variety of services, whether it's advice, whether it's hedging, whether it's derivatives, or it's FX, whether it's payments, whether it's credit cards, none of which we want. And so I sometimes say, we want the asset but not the client, and banks want the client but really don't want the asset in the new regime, other than sometimes. So I actually envision a very cooperative world of, in the vast majority of cases, will there be places there's competition? Absolutely. And it won't just be with the banks. It will be with the investment-grade, regular way corporate bond market. But there is a role for private credit beyond what levered lending is, and I think we're in the infancy of that.
Thank you. Now, this is a question for the whole group. Monetary policy obviously is very important, but it's not the end all. Can you name a development or trend outside of interest rates which has had the most significant bearing on your firm, and maybe elaborate on the impact? It could be a challenge or an opportunity. Who wants to take a stab, please?
Well, thank you. Again, that was a choice, huh? I think there's a very large opportunity, but it's a very difficult opportunity for banks, and that is the role we play in ESG and climate financing. We deal with many of the basic companies still, notwithstanding what Marc said, who need financing needs to improve their emissions. And it is important and it's challenging because the quantum of financing is huge. So there's a role for all of us on this table on that. Second is, it's an area where, thanks to the work of many of the CEOs sitting here, Noel Quinn, Mark Carney, others, that standards are being developed, but they're still not solidified. And we all still don't know the true price of risk, and it's being intermediated by governments. So it's a great opportunity, but there's a challenge in making sure that we understand the risks and the benefits.
I'd say in our business, the biggest driver of our business over the last 15 years is indexation and concentration. So I look at capital markets, and if you look at the US capital market, I ask myself sometimes whether we have an equity market. 80% of volume is S&P 500, 60% of the market is ETFs. 10 stocks are 35% of the S&P. Those 10 stocks, last I checked, traded close to a 50 PE. I wonder whether we have lost kind of fundamental analysis. You can look at active management. Active management has had a very poor experience over the past 15 years, failing to beat the index, I think, 85% of the time. And the conclusion, and therefore the driver of our business, not just in the equity market, because everything I've said about equity applies twice as strenuously to fixed income, public markets seem to be devoid of alpha. They seem to be liquidity driven rather than fundamentally driven. And what we have built and what the entire private asset business has built is a source of alpha by stepping back from public markets. And we used to think public was safe and private was risky. Well, I think we now know public is safe and risky, and private is safe and risky. They're just differing degrees of liquidity, and private assets now range from AA to equity. They're not just buyouts or venture capital or high-octane investing.
Thank you. David?
I'd comment, and this is a forward-looking thing, and we'll see how it plays out. I'd comment on the Basel III endgame, in the U.S. And we've been talking here and in the previous panel, we're going through a very, very significant tightening cycle for the first time in a long time. And as Marc, just appropriately highlighted, there's a balance that the regulators choose in how we regulate the banking system and how that forces activity in and out of the banking system. And that will evolve over time. And certainly I think both the banks and activity outside the banking system are going to be incredibly important for capital formation in the capital markets. We believe very strongly in a regulated system and keeping the banking system, safe and sound. I think James made some comments in the previous session, just around the role that the large banks played when we had a handful of banks that had trouble, earlier in the year. And while we want the system to be safe and sound, when I look at these rules, I think these rules go way too far. And if implemented the way they're outlined, it's a significant additional economic tightening, on the system at a time when I don't really think, that's in the best interest of economic activity and economic growth. And I think there are three obvious things that will happen if the rules are imposed, this way in the U.S. capital markets. The first is the cost of credit for all borrowers, large companies, small companies, everywhere, will increase. Secondly, the U.S. and its competitive position will change if this capital goes in that way, and it's very differentiated from the way the rules are being put in place, in other parts of the world. And the original purpose of Basel was to normalize across jurisdictions, these capital rules. And, the third thing is, per what Marc said, that balance of what's in or outside the regulated system and how it evolves would continue to evolve. So, we and others, obviously will continue to advocate around all this, but, this feels like this would be a very major thing if it went in, on this basis, and would have an impact on capital markets activity and growth. And so we're hopeful with all the commenting that's going on, there'll be some adjustments.
Can I take what Marc said just a little bit further? Because I think there's a major asset allocation switch going on in the world between public markets and private. And in most places, there's a very rapid shrinkage of public markets, whether it be take privates, whether it be a shortage of listings, et cetera. And I think what you're seeing is, particularly in the wealth sector, where individuals have not participated fully, or rather the largest number of individuals have not participated fully in the growth of private markets. I think you're going to see a convergence of those two trends. And I think a private company which trades on a regular basis, potentially on an exchange, is no different from a public company. And we make a very big distinction between those two asset classes in our world, the same way as 20 years ago an equities division lived completely separate from a fixed income division, and now they're part of the same ecosystem. I think you're going to see exactly the same between public and private. And the advent of DLT technology and others may facilitate that, but more and more the coming together of that arbitrage, I think, is the thing that we have to watch most in our business.
I think that's an interesting topic. Maybe I'm just going to expand on that a little bit with Marc. Marc, if you could maybe talk about, how you see the shadow banking industry, and also, given what's been happening in the U.S., private credit, private equity, how do you see it in the other parts of the world?
So the changes taking place have taken place primarily in the U.S., but debanking is a worldwide phenomenon. In the U.S., there is an advantage of a robust capital market. In Europe, which is doing exactly the same thing to its banking system, you do not have this robust capital market. You're starting to see economists and others begin to comment that we can't really do that, tighten on the banking system without creating capital markets alternatives for all the reasons David said. But let me say something that may surprise you. I actually agree with everything David said. We have a very safe banking system, and this is now about regulatory choice or regulatory overreach, depending on how you do it. But I also want to pick up on something Colm said in the last session. When something moves out of the regulated sector to the unregulated sector, it does not become riskier. The banking system is a safe system, but it borrows short and lends long, and it is levered. When you move something from the banking system to the asset management system, for the most part, you're moving it from a levered system to an unlevered system. If you're moving it from the bank to a BDC, you're moving it from 10 times leverage to 1.5 times leverage. If you're moving it from a bank to an insurance company, you're deleveraging. In almost every one of these areas, you are deleveraging. That does not mean investors will not lose money, but investors could just as easily lose money on the S&P 500 as they can on the credit system. So I do think democratization of credit, finding the right balance between banks and investors is an important thing, and having the risks of financing the economy borne in a democratized way adds robustness to the system rather than concentrating them in 4 big banks. And I think we've seen that now around the world. We may be in a point of overreach where too much is coming into the marketplace, but I think we'll end up with a course correction, particularly in Europe, because Europe is not set up to absorb in the capital markets that which the banks don't do. In the US, there's a better chance. And back here, I think, to the comment that was made here, trading capital in the world is 10% of what it was in 2008. Markets are 3 times their size. We have this notion that public is liquid and safe. It's not. We actually have seen our first wholesale market failure. This is UK LDI. People think this is some crazy thing UK institutions were doing. It wasn't. It was a mistaken belief that they could sell AAA and AA obligations at the market price. They were wrong. They tried to sell, the market cratered. They tried to sell more, the market cratered further, and government had to intervene to prevent destruction of capital. I think we are going to see that more and more happen in the world, because just like there's regulatory overreach as it relates to assets and capital, there's been regulatory overreach, in my opinion, on the penalty associated with trading capital, and therefore the provision of orderly markets, making public and private much closer than people have ever thought of them. And we haven't adjusted our mentality of how we asset allocate yet.
Yeah, I think just to build up on the LDI point and the point Marc made earlier about equity capital markets, over the last 30 years in the UK, what LDI was designed to do was to make pension funds safer. And UK pension funds had obligations which were long-term, monetized in terms of inflation and credit, so people bought long-term inflation, long-term credit, and they therefore reduced what they call the funding risk. And so the funded ratios in UK pension funds went up, from around 100% to 130%. At the same time, equity allocations decreased. So not only do you have a shrinking public market, but you've got a smaller public ownership of equities, public equities, in either personal accounts or in pension accounts. And that, I think, has a longer-term consequence for the risk-taking culture of the UK, for example.
Absolutely.
Let me just expand on that for a second. So we're talking about liquidity, we're talking about LDI. With the US fiscal deficit, You know, if you take out the student loan adjustment at minus 8%, do you think there's an overcrowding effect? Do you worry about the liquidity? Is this a topic that, you know, is talked about?
I thought I was thinking too, so I'm just.
I'm happy to start. I'm sure you have a comment on this too. I think we absolutely have to worry about what's happening with deficits in the United States. I think the panel previously, there were some very, very, appropriate comments just on the growing size of the debt, the cost of refinancing that debt in a different environment than we've had for quite some time. Who are the buyers? How do we develop new buyers when you have governments, when you have central banks, and also, foreign governments that have been such a big buyer of treasuries? And I think the important point to make that's been made in the discussion about LDI is just the fact that liquidity in all markets is generally fleeting. And at moments of stress, there's much less of it than you expect in any market. And so the clearing price under stress is very, very different than the clearing price when markets are functioning. And, I think in all markets, including, markets for government debt, there's risk of stress. We saw that, by the way, in March of 2020. And, in my opinion, we will see it again. And so how you prepare and are, ready to deal for that, I think is an important part of risk management that any organization has to think about.
I agree with everything David said, but I also think we should look at the broader trend in asset management. We are going to transfer value from equity to debt over the next few years. Every time there's a refinancing, value is being transferred from equity to debt. And on that refinancing, not only is the rate higher and therefore more of the cash flow being diverted to debt holders are in a position to say to equity, put up more equity to own the same asset. Returns on almost all equity that is invested today are going down.
That's why multiples have come down, but multiples probably have to come down more.
It's also a reason you see so much capital in private markets, but none of it being spent. If you committed a great number of sins over the past decade, you are holding capital to figure out how much you need to pay for those sins as you refinance and as you deleverage. And I think until that works through, we're not going to see really robust deal activity, because I don't know that a 5% base rate really is impactful. It kind of feels normal.
So I think, though, in the context of a shrinking banking system, there is a role for a banking system here in times like what David described, which is we are not the lenders, the big banks are not the lenders of last resort, but we could be the lenders of first resort. So rather than in periods, recognizing liquidity has come away from the market, if it may be better for the system to have more robust financing agreements and arrangements between institutions and banks so that they can weather short-term crises by using the banking system to borrow against rather than sell assets. It was used a little in LDI. In a way, it was used a little in the US regional crisis, but I think we need to see more of that. It's a way to recognize that problem.
This is a point I'd just like to take one step further and elaborate. Banks are a shock absorber when there's pressure in markets. And when we look at the regulatory infrastructure, it's wiring the banking system so tight that it's taking away its ability to act as a shock absorber. There are very, very significant buffers, but buffers can't be used even at a time of stress. You actually, in a time of stress, want the banking system to use its buffers if the banking system is acting as a shock absorber in markets. So I just think that's something from a regulatory perspective to keep thinking about and looking at.
So I hate to pile on, but coming down the line, because things are wired so tight in the banking system, and we are not a bank and we don't have access therefore to borrowing windows on a normal basis, we hold immense amounts of liquidity. And that's incredibly inefficient, which just means the cost of borrowing for everyone is higher. And it would be a much more efficient system to be able to depend on the banking system in some reasonable way for high quality collateral in times of stress. Holding $15 or $20 billion of capital and a balance sheet our size is not the most efficient way to run a business, but it is how we run the business.
And just picking up Venkat's point, it was the collateralization in the LDI system which caused the problem. You had a 30-year asset and a 30-year liability. It all should have been fine. But the need for daily collateralization caused the forced selling, which actually undermined the whole system. It was the tightness of the buffers which was actually the problem, not the match.
Fascinating discussion. I wish I could just keep asking questions, but I would like to give the audience a chance to pose some questions. Gentleman over there.
I have a question. Regarding the private credit industry, is it going to get regulated given all that's going on? Will it become more like the banking system at some point?
The question had to do, will private credit be more regulated? So the answer is yes and no. Private credit is, to the extent it performs credit origination type activities, is already regulated. You know, I jokingly say I barely get the fingerprinting ink off of my fingers from the number of regulatory interactions that I have. We're just not regulated the same way.
You could join our world and have more ink on your fingers if you'd like.
So, we own a very large insurance company, a retirement services business. We do no maturity transformation. We do not have access to the Federal Reserve. We do not have access to any form of government guarantee. And so, are we regulated? We perform the same stress tests that others were talking about at year end. We perform cash flow testing. We have state regulation. We have federal oversight. We have Europe looking at what's going on in the US. We are regulated in a way that reflects the substance of our business of not doing maturity transformation, not taking deposits, and not doing other things. And from a disclosure point of view, we actually put 100% of our portfolio online. We put our stress tests online, just point and click. I think that to the extent you are in an institution that is a financial institution, you will be subject to regulation. We are today, and it's clear that the trend everywhere in the world is increased regulation. That there's no doubt about it. With respect to investors participating in what is called private credit today, which is really levered lending, I would be very surprised if that activity, other than in the press, is of any substantial interest to regulators. It is, as I suggested, mostly moving off of regulated balance sheets into unlevered investment funds, which is fundamentally good for the system. The one I actually worry about is places where maturity transformation is taking place in illiquid markets. So think of the biggest market in the world today, where you borrow short and lend long. I throw it back to you. Daily liquid mutual funds. If you have something where you offer your clients their money back every single day, but you have assets that you can't trade very frequently because there's not trading capital, that is where you build up systemic amounts of risk through a mismatch of the underlying assets that these institutions hold. But regulation, and more of it, I don't know that we're going to get to 80,000 pages, but I bet we're at 40.
Thank you. I think we have time for maybe one more question. Gentleman over there.
So if you were to believe on the assumption that climate risk will lead to the biggest repricing and reallocation of capital in the history of the world, what implications will that have to the shifting of assets and banks, right, from high carbon or high climate risk versus low climate risk, and to the to the private assets, to the private credit markets, Marc?
I think he said Marc.
I felt like I've been speaking too often anyway, so I'll just quickly say, most of the capital that I see being required for decarbonization, energy transition, use your term, is not actually equity. It's debt and hybrid. I think it is going to be the largest use of capital since the invention of fire. And we see it everywhere across almost every company, and it is mostly, in our opinion, brown to green, and it is a financing activity. And that financing activity is throughout the banking system. It's a very, I know from my colleagues, this is a very significant portion of demand. And for us, just like any other financing, we are going to be large financiers in the private credit market of decarbonization. And what is particularly good for us, we need long-dated assets. it's a very interesting kind of dynamic. Banks generally prefer shorter dated assets for shorter dated capital. Most of the world is 10 years and in. The world is short, long dated assets. There's actually a reasonable sync up between the needs for energy transition, which can be very long dated, and the requirements to provide retirement income, which are equally long dated but not adequately met in capital markets today. So I'm optimistic that this will be a very significant source of product on a very long dated basis and will be matched with retirement systems directly or indirectly throughout the world.
Thank you so much. I learned a lot, and please, everyone, join me in applauding these gentlemen.